Hello, Market Chameleons. Happy Friday. Before we get started, I have to apologize about the cricket in the background. For the life of me, I can't get this cricket out of the barn. So we'll start with that. I'll try to stay on mute so it's not too annoying. Why don't we get on with the disclaimer to start, D? How about that?
Yep. Good morning, Will, and good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer questions and provide you with guidance. There's a disclaimer.
All right. So what do you got on tap for us this morning, buddy?
So we'll continue again with the Q&A. I think it's been good. People have been coming in, asking good questions, showing different scenarios that they're playing out. So this is your chance. Anybody, you have questions, it could be anything regarding, Market Chameleon tools, data, statistics, anything you're doing as far as trading goes. If you're experiencing something that you weren't expecting, or you have a particular question about something you're seeing, this is the time to ask, because besides having the tools and data available, the most important part is that you're learning, you're educating and learning from experience, right? That's really the path to success. It's not trading or trading, it's learning as you go, getting experience, improving, and obviously there are people doing different things. So even situations that we may have not experienced before, I mean, we've been in a long time, we've experienced a lot of stuff, but there could be something out there even that we haven't seen before. So it'll be interesting, if we can't answer, we'll tell you, but this is the time, to share it, and it'll be to the benefit of the entire community, especially, people haven't seen something like that before, didn't think about it. This is a chance to learn. So two ways you could ask your questions. You can put it in a live chat. Will is monitoring that live chat. He'll read off the questions to me as they're coming in. Or a better way to do it is we'll put in a link there on that YouTube chat. You click on it, that will take you over to Zoom. When you get to Zoom, there's a button there to raise your hand. This indicates to Will that you want to ask your question. You don't have to turn on your video camera, but you unmute yourself so we could hear the question. And this way you could guide us to where you're looking, tell us about the surrounding circumstances, a much better way to ask the question. So while we're waiting for things to queue up, there's a small delay. What we'll do is, as usual, we'll take a look at what's going on in pre-market hours. We'll begin with that. If no questions come in, or if it's taking a little bit of a while, I do have backup questions from either previous shows, things I'm getting through the email or through chat. So I'll default to those while we're waiting for questions to queue up. So without further ado, let's start with the pre-market report. These are stocks that are trading in a pre-market hours today. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. If we scroll down here, we see 141 stocks made our percentage gainers list, 41 on the percentage decliners list. So from that perspective, it looks like right now we're setting up for a more bullish bias at the open. Let's take a look at the higher market cap stocks to see if we're seeing a similar situation. So I'm going to go here, market cap filter. Let's look at market cap 20 billion or higher. So there we see 42 made our percentage gainers list. Only one right now on the percentage decliners list. So there, again, looks like we're setting up for a more bullish bias at the open. Okay. So I'm going to just unfilter this really quickly. And Will, I don't know if you have questions already queued up. If not, I'm going to, kind of go to
some. No one's raising their hand, and there are no questions in the chat either. So you can go with some older questions.
What I'll do is I'm going to go. So this is a question I got yesterday. It was through an email. It was actually not even a question. It was more of like a comment. And it was by a customer came to the website kind of for the first time, tried out a implied volatility scam. And when he tried it out, this is what happened. He was comparing the implied volatilities he's seen on his broker. So he has two brokerage firms that he's using to scan. Okay, I'm not going to mention, but two large brokerage firms that everybody would recognize. And he's running an implied volatility scan. On those brokerage firms, he's seen an implied volatility. Then he goes to MarketChameleon and says, I don't see the same. And he gave me the symbol. I'm going to show you guys the symbol. He gave me the symbol and said, well, I'm not going to use your scan because there's a symbol. It was, I wrote it down here. 1 second. I already forgot the symbol. Okay, it's FSS. So the symbol is FSS. Maybe you're listening to, I did invite the person to come on the show and ask the question. So he said, this is what he said. Both my brokers show an implied volatility of 58, okay, or similar, around 58. And I forget what we were showing, something like 18 or 20. So he said, obviously your implied volatility is wrong. I'm not going to, and this is why I like he said he did give some comments. I like your website and stuff, but you have to have accurate implied volatility. And that was it. So I'm going to show you right now. So there's a few things that this person did, right, that's telling me he's not even ready to trade. So one of the things, right, what would you do if you saw something, right? So obviously he assumed, okay, I confirmed it, it's wrong. One thing though he didn't do, which is obvious to me, is he saw something that didn't match up and automatically assumed this one is right, this one's wrong, maybe even did a trade on it. But his point was, well, the implied volatility is 58. That's a high implied volatility. I want to sell it because historical is like 25 or something like that. So this is the danger of like what people, what do people think he did wrong? What is like the first thing you want to do as a trader in that situation?
Make sure you want to check all your data, right? Not just
right away. The first thing you want to do is check the data, right? It's there. The options are there. So right away, you got to say like, this isn't adding up. Let me look myself and confirm what is the data. If you're not doing that, honestly, that was pretty scary what I just heard. Like, and I'm going to show you what's going on here. But, if you're not looking and confirming, like figuring out like, well, what's going on here, just assume something like that. It's very dangerous, maybe even did a trade, but I'm going to show you what's going on. And
it's a reason why a show like this and the fact that you respond to people asking the questions is helpful. And, the Jake is on and, so the Discord is also, I'm sure, super helpful where people can discuss what they're seeing and get feedback, right?
So I'm going to go to the symbol here. Exactly. This is a very, and this is sometimes like when I get, I'm like, wow, like these, like, sometimes it's scary. So I'm going to go to the options chain here. So one thing people don't realize is that they think the implied volatility of a stock comes from the stock price. They say, oh, FSS implied volatility is 50. So everybody has to have 50 because it's coming from the stock price. That's incorrect. Stock prices do not have an implied volatility. Okay. Implied volatility is this derived value from a model. Okay. The model has estimates in it, and then the model has to reference option prices. Okay. So there's a lot of factors that go into a model. It does not come from a stock price. So you can't look at IBM stock price and get an implied volatility. It doesn't work that way. You're getting it based on your observations of where the options are trading, okay, and where you think you could get the options off, right? That's an important factor. Like, where do you think the options are really trading? And let me show you what happened here. Now, FSS didn't even pop in our scan because their thresholds in there didn't even meet. So he just kind of found it on their scan. You could find it, but it didn't come in, it didn't even make our implied volatility ranking scan. So here's why, right? When you calculate implied volatility, there are a lot of things that go in it. It's a methodology. It's an algorithm. It's how do you treat the days to expiration? Like, do you use trading days? Do you use business days, how do you compensate for half days? How do you decay it? How do you, treat weekends? I'm sorry, holidays, what is your dividend assumption? What is your interest rate assumption? All these are estimates. But look at the markets here in FSS. It's zero volume, right? There's really no trading going on here. And it's kind of been consistent here. So there's no real trades, zero volume. Look at these markets. I'm just showing you this is the at the money, right? 39. So this is the closest at the money. It's a nickel bid at 420. Here's 65 cents bid at $5. Implied volatility. Remember, when we're deriving it, we have to find an option price. So this option price is 5 cents. Based on 5 cents, if you use the Black-Scholes model, the implied volatility is 10. If you use 420, implied volatility is 184. Of course, you could use the midpoint, but realistically, what is the implied volatility? There's no trading. What do you can't really get. The best you could do is put a reasonable placeholder, right? Because the implied volatility is not really 100 or 180 because there's nothing on the board you could sell that. You could go through, right? Here's 19 vol. This is the highest you could sell right now. 28 vol over here, right? You could buy 41 vol. You could buy 35 vol. So here it's suggesting it's not even 56. I'm not sure where he got that. Go out to November. Right? Look how wide these markets are, 19 vol. So to go out and sell an option, this is not even, besides, I don't even see how you have to check the data, right? You have to check the data, assuming that and he was, and I'm only bringing this up, and if you're listening, don't worry, because I'm hearing this a lot, right? Like this is a repetitive thing where I'm hearing like the implied volatility is not matching up with my broker. That means you're not accurate. That's not how it works, guys. Implied volatility is derived value. It's using a methodology, and we're using an algorithm from years of experience to try to see where the implied volatility really is, and is it even reasonable to make a guesstimate? Because if it's too wide, we really don't know where it is, right? There's no trading going on. There's too wide of a market. But even to go there and assume that you're going to go sell an option here, let's say in a from month, just looking at it, because he really thought he missed an opportunity to sell an option. Like if you sell this at 5 cents, let's say even if you sold it in the mid market, like $2, right? Look what you're doing. Your exit. If you change your mind and say, "Oh, I got the wrong vol there, or I did something wrong, I got to exit." You sell this at $2. You don't know where you're going to buy. You just know here's the offer, 420. So does that make sense to sell something that you think if you're wrong, you're paying 420 to get out? You're selling something for $2, paying 420 to get out. Like, these are all things that you need to consider when you're scanning for implied volatility. You have to go and look at the data in the markets. It's obvious the way it was worded, this question. I don't think that even happened.
There's some great comments by Jake, who's in the Zoom. And his last one said, if you were an experienced money manager, it would only take a glimpse at the option chain to figure out this ticker is not tradable, whether the volatility is correct or not.
Yeah. And that's why, I missed an opportunity to sell an option. Like, well, I don't even see trade, I don't even, there's no volume in these things. So, these are the markets. Where's the opportunity? If you're first, if you're seeing something, if you're seeing data, or you're seeing something not match up, if you're not going and looking, like, I'm not sure that you should be trading. You shouldn't be trading options. Put it this way. I'm not sure about that, but for options,
you should be doing more research and coming to more shows like this, and watching more videos. You should be
Yeah,
on Discords like the one Jake set up. And I'm going to take, Jake has such a good point about doing research. I'm also going to copy it and put it in the chat. It's too long to read, but it's just, you basically have to do lots of research on multiple points before you make a decision to trade.
yeah, you got to
It should take
go
100
like,
times as long as entering the order to decide what the good aspects of the trade are. It's not one point like
exactly. I think people are more this. They think it's about the speed of entering the order, the speed of execution, and they ignore everything else, right? I just need to find something and concentrate on the speed of execution, getting my execution. And when you're not looking at the data, you're not looking at the information, you're not doing the analysis, you're going to get in really big trouble here. Like this would, I mean, I don't think he did a trade, because I see zero, but it was, you gotta like go check. And another thing is people think they're trading implied volatility because you saw some YouTube videos. Okay, if your entire education about implied volatility came from YouTube videos or like maybe some Google articles, you're not ready. That's not you might think you understand how implied volatility works. You might even, be totally convinced, but I will tell you that with it, it's going to take you experience of trading implied volatility and really, when you're going to start to understand it, go read the Black-Scholes model, derive it in an Excel spreadsheet, and what you see people telling you might start changing your mind. Okay, until you do that, unless you have a lot of experience trading it, unless you could go take a look at that Black-Scholes model, put it into your Excel spreadsheet, it's out there, it's the formula, it's no secret, it's out there since 1973. So, because like the things that people are saying, like, and I understand you're seeing things on YouTube. I even understand, like, listen, he named some big brokerage firms, right? So I could understand, I don't want to say them, but I could understand he's running their scans. And what did they do? Like, look, the simplest thing is not to create this algorithm, right? To like check things. You could just say, here's the bid, here's the offer, mid-market 100, right? Or 56, whatever it was, you put that in and that's it. That's the simplest thing to do. That's why if we were doing that, probably we would start matching up with, but it's not realistic, right? Like realistically, you're trying to create an algorithm to kind of get a sense, is this even tradable? Do we even know where the implied vol? So here, I think I went in here to the implied vol rankings. I don't think we even included this. So you see, it's not even in our scan. So you couldn't find it in here. But why? Because we don't know really the essence of that implied volatility. It's not trading. The markets are not tight enough. So where it actually is, where you could actually get in and out, it's an unknown factor. Okay. And I think it's just important. Like I kind of want to stress it because I've seen these type of, comments and questions, reoccurring, I mean, in the last 2 years, and just wanted to bring that up. You're definitely not going to be able to see the same implied volatility from broker to broker to broker because it's a methodology, and even from our website to your broker, because it's a methodology, where a lot of factors are going in. Which option prices are you referencing? How much weight you're giving to the options. Like, are you giving more weight to the tighter options? Are you giving more weight to the at the money options? Are you only using an at the money options or the surrounding? So there's a lot of stuff going on there to create that index. But yes, you will not see the same thing from platform to platform, because it's not like a stock price, right? It's not like an observed stock price where we know Apple is 154.07 because that's an actual trade, right? That happened. So that we know. Implied volatility is not like that.
Hey,
So I
Dee,
wanted to
we
start,
do
yeah,
we do have one live question that
yeah,
they've been holding a while.
okay,
Uh, it's
yeah,
Satya, and are you okay if we allow
yeah,
the
definitely.
conversation? All right, here we go.
Yes.
All right, you're being allowed in, Satya. Here you go. How you
Hey,
doing,
Sky,
sir?
I think you're on mute. You have to unmute your mic.
Satya, you
I
there?
Sky, just unmute your mic. You're on mute. We can't hear you. Yeah, Satai, there's a mute button on the bottom of your screen. There's like a mute button with like a red, cross. Just click on it so you could unmute your mic.
I just asked him to unmute through a click of a button too. Here we go. How you doing, Satya? Hello.
Satai, hello? We can't hear you.
Oh, he just chatted in. Unfortunately, Satya does not have a microphone.
Okay.
So, Satya, maybe type in your question. We'll try to get to it. We appreciate you making an effort to come on. So, until we get that, D, that was the question.
Okay.
Sorry that didn't work out.
No
Don't
problem.
worry about it, Satya. Thanks for trying.
Yep. Any other questions out there that?
No other questions.
Okay. So, I'm just going to really quickly, I'm going to just do that, just come back to that FSS, right? There are a couple things going on. We talked about the implied volatility, the methodology, right, that you use. And it is how you treat, these options. Because like, look, if we're looking at the surrounding options and saying, well, really realistically, where do we get this implied volatility? You're looking at the 40 strike, 45, 35. These almost don't even matter anymore, right? No bid 480. So you're going to have to, unless you're putting them in there, okay. But, the algorithm, the way, if you want to kind of get the essence of the implied vol, right, you're giving some weighted average, and then you got to make a determination. If it's very wide, maybe then you don't really know where it is, right? So that's one of the things. How do you treat wide markets? I mean, how much weight do you give? And do you give equal weight, or do you give more weight to tighter markets, right? Do you give less weight to wider markets? At what point do you exclude them? And that's kind of like a derived formula. And when we take a look at an implied vol 30, right, it's an index. So it's just saying that if we created an at the money 30-day option, what do we think theoretically the implied volatility would be? And you're kind of sticking to a formula, because I don't have an exact 30-day, right? I have 26 business days here. I have, 51 days here. So you're using basically an index, right? So this way, because if you have an index that's consistent in the methodology and formula, then you could track it from day to day, right? So this way, so the 30-day IV, right, where we see 30-day IV does not apply to every option, right? That doesn't mean every option is 26.6 vol, right? Because they're all different volatilities, right? Even as I scroll through. Why do we use that index? We use the index to basically get a sense if implied vols in general are moving higher or lower, but then you got to go to the options chain and really look at those options. Okay, so think of it as, I think we use interest rates, right? We know the Fed funds rate as at 0. So if we compare it to historicals, that's very low, right? But does that mean my credit card is going to give me 0? No. I have to go look and say, well, what is my credit? What if I borrow? And maybe my credit card is the same rate as it was when, interest rates were 2 or 3. It was 18% then, it's 18% now. So that's why you still have to look. We use an index to get a general sense of if levels are moving up or high. But once we get that, then we kind of go look deeper and say, okay, so let me take a look at these options. Every option has its own implied volatility. There's skew involved. There's also options with different maturities. So that's why you kind of go in here and start checking, right? You start checking the data, checking the markets, and making a deeper assessment of, what's going on overall. Is that any questions on that? Like, do people kind of get that?
Yeah, I think no one's responded with any questions on top of that. So I'm assuming, actually, Robert just came in. Robert's asking, Dimitri's explanation about probability and the risks and risk are perfect. 9 out of 10, you would win $1, and 10 times you'd lose $1 million. Would you take the bet, is what he's saying. So,
yeah. So that's the other thing, I think people look at when that's a good point, because another thing that I think people start to focus on is win rates, right? I need to win a lot, right? I need a 70, 80, 90% win rate. But what they're missing out is that, what about the payoffs, right? Like, what about the payoff? Because if your payoff, even if you have a high win rate, if the time you lose, the loss is so extraordinary that it wipes out all the 9 times you won before, then it doesn't work out, because what you're doing is you're trading for a negative expected return, right? So you're going to have more winners than losers, but you're still trading for negative expected return or expected value. So that's not, so when you're doing that and you're focused on win rates, and that's why I think a lot of people tend to, say sell options, right? You need to sell out, because selling options, you're going to have more wins than losses. But, what you have to do is then consider, well, what is my risk, and am I going to blow out all my wins, all my gains through this one time or whatever loss, that's going to occur. And that's why we analyze the options. We analyze the data, the information, and try to really assess, what is the expected value of the options that you're trading, the probabilities of, success, the risk reward ratios. All this has to come into play. These are all factors that are important, because if you only focus on one, then you could get into trouble, right? That's what happens. You could get into trouble. So we covered kind of implied volatility. It doesn't come from the stock price. A stock doesn't have an implied volatility. It comes from the option prices. It's a derived value. Usually it's an index. It's a methodology, because it's what did you use in your model to derive that estimate? It's not going to be the same throughout, right? Because it's not something that, implied volatility is not a trade. It's a derived value. Then we talked about also, the markets, checking the data, checking for the information, seeing what's actually happening, right? You have to see. And like Jake said, from experience, somebody who went to this options chain would right away see it, right? Like right away say, okay, this isn't tradable. These are wide. I don't know what the implied, this is not, if I'm looking to sell high implied volatility, and as my strategy, right away, anybody who would take a look at this would say, this is not a good candidate for various reasons. So no questions, we'll right up at 9:30.
Excellent. Just a couple housekeeping notes. It is Friday. On Tuesday, we have a IBKR webinar with you, correct? 2 p.m.?
Yeah. Tuesday, we're going to do an interactive brokers webinar. It's going to be on scanning for repeat option block trades. That's going to be the topic.
And that is Tuesday at 2. And if you register and can't make it, they will email you with a recording of the webinar. I think that's correct. So I will put that in the link, and I will remind everyone on Monday. D, you have a great weekend. Chameleons, have a great weekend as well. Thanks so much, my friend.
Yep. Thanks everyone for joining. Stay safe out there. Have a good trading day, and hope to see you guys on Monday.
Trade in peace, Chameleons, and have a great weekend.